Hello, everyone, and welcome to my YouTube channel. It is a great pleasure to have Luke Gromen with us today. He is the founder of FFTT Limited, which is Forest for the Trees. Beautifully named, I have to say, macro research house. How are you, Luke?
I'm doing well, Daniel. Thanks for having me on. It's great to be here, and it's nice to catch up finally.
Very good. Luke, you have a very unique perspective of the geopolitical risks that the United States is facing relative to China, the position of the US dollar, and the monetary imbalances and the monetary risks that the US dollar faces. I know it's a very it's a very complex subject to start with such a broad question, but I would like you to, if it's possible, summarize for our viewers your view about the risks of the US dollar as a world reserve currency in the current situation.
Sure. So I think the best way to frame it up, I think, is that if the U.S. dollar as reserve currency, there's two components to it. There is the dollar itself, and then there is the primary reserve asset of the world. And if you look back historically, hundreds of years, historically, the primary reserve asset of the world was gold.
Mhm.
First, for several hundred years through the sterling, and then from 1946 to 71 through the dollar. And since then, effectively, the primary reserve asset has been US Treasury bonds, but that's been enforced by the dollar's monopoly in the pricing of oil and other commodities. But oil and energy are really the big ones. And so that was the so-called petrodollar system. And so what I think we are actually in the middle innings of, I think we are well into the process of change, is I think the dollar will remain the global reserve currency. And so you'll see me on Twitter, you'll hear me in appearances say I think the US needs the structure of the dollar's reserve status to change, not necessarily the reserve status to change, but the structure. And so what I mean by that is that the dollar will remain the reserve currency, but the treasury bond will lose as being the primary reserve asset of the world. In other words, as you have these surpluses that aggregate in places like China, Germany, the Middle East, South Korea now, you're already seeing in real time, we've been seeing this for years, foreigners have stopped buying treasury bonds. They have stopped growing their holdings of treasury bonds. Foreign central banks have not bought any treasury bonds on net in 7 years. And they have been buying marginal amounts of gold at a floating rate. The biggest creditor to the whole system, China, has been buying pretty much anything that isn't treasury bonds. They've been buying ports, they've been buying copper mines, gold mines, oil fields, etc. But so I think what we're actually in the middle stages of living through is this transition from the post 1971 system, which was dollar as reserve currency, treasury bond as primary reserve asset, toward a system that is much more multilateral in that the dollar is still reserve currency. The treasury bond is no longer the primary reserve asset. And imbalances are settled in a neutral reserve asset. Primarily, if you look at where imbalances happen organically within the global economy, a disproportionately large percentage of those imbalances, those surpluses and deficits, occur in commodities, and in particular, oil markets. And so I think what we're in the early stages of watching is, or the middle stages, excuse me, of watching is this system transition from this post 1971 dollar centric system where with dollars reserve currency, treasury bond is primary reserve asset, and all oil is priced in dollars, to a system where dollar is still reserve currency, oil is also priced in yuan, oil is also priced in euros, and then the imbalances that exist that remain are settled in a neutral reserve asset like gold. And so that's, I think, the transition we're making. There's a number of different reasons why it is happening, and we can go into those. But I'll pause there and see if you have some follow-up thoughts.
Oh, so as you see that that transition happening, more commodity producers accepting different currencies. And what is actually very evident, which is that it's more the Federal Reserve that buys the Treasury, whilst the biggest holders of U.S. Treasuries become U.S. centric instead of foreign buyers. You have, for the first time in many years, Japan overtaken China as the biggest holder of U.S. Treasuries, precisely for what you were mentioning before. But you were mentioning at the same time that you think that it would be those imbalances would be settled in a different currency, be it gold. Do you see some element there for cryptocurrencies, or do you think that cryptocurrencies are completely outside of that monetary settlement basis that you were mentioning?
No, I think there is a role for them potentially. I think it will ultimately come down to what policymakers decide to do, and I think there's a case to be made that the United States itself might actually favor something like a Bitcoin relative to gold if the system is going to move to a neutral settlement asset anyway. There's a case to be made that the U.S. government would favor Bitcoin to gold because ultimately gold in certain eyes in the United States government gives away power to China and Russia, since China and Russia produce more gold than the United States. And so to the extent that they are producing more of the neutral reserve asset, were gold to be that asset, there might be parties within Washington, if they are forced to a neutral settlement asset by events, that would say we would rather have Bitcoin where it's a fixed supply. We can track the on the blockchain all the transactions. It's instant or nearly instant settlement. It doesn't have the same problems of storage, etc. So I think from a governmental level, I think it would depend on policy. But I think what we're watching in real time in the U.S. and elsewhere around the world is the market speaking in terms of what prices are doing. People are saying, I see what's happening here. I can see where governmental debt levels are. I can pick up a history book. I can get on the web. I can listen to economists saying, "Here's how it worked out last time." And we're certainly one of those economists or those strategists. And I need to protect my savings. And so we're seeing the market speak. And I think I've been on record saying that I think Bitcoin is really and some of the other cryptos are really the less functioning smoke alarm in terms of the currency debasement that's happening. And so I think you're seeing the market speak. So it's possible we end up with a two-tiered system where crypto and Bitcoin are the neutral reserve asset for the people, and gold is a neutral reserve asset for the central banks, for supranational settlements or something like that. There's a lot of different ways you can slice that, but I do think there's a role for them, for crypto and Bitcoin in particular.
So in that perspective, one of the things that springs to mind is obviously gold is massively undervalued where it is right now, and U.S. Treasuries and sovereign bonds in general are hugely overvalued. Now there is this, and probably the reason why that difference or that mispricing persists is because of a market perception that things can change rapidly, or a market perception that the economy is doing very well. What do you think that makes that differential so wide and so persistent, so far at least?
I think it's a couple of different things. I think the biggest part of it is it's been 100 years since we had a global sovereign debt bubble, and so I would equate probably the most similar time to now when you look at the global sovereign debt market, particularly post-COVID, is in the immediate aftermath of World War I.
Yeah.
And you had these impossibly large reparations that the Germans owed the Allies impossibly large war debts that all the Allies owed the Americans. The Americans were the creditors of the whole system. We were the biggest factory of the world, etc. And when you look at what happened, if you look at the six major industrial powers in the immediate aftermath of World War I, they were the United States, the UK, Germany, France, Japan, and Russia. Within 12 years, all 6 of those saw their sovereign debt fall 75 to 100% versus gold. 2 of the 6 hyperinflated the currencies basically to zero. The Germans, of course, famously, maybe a little less famously, the Russians. And that's not our base case in this whole situation. But I think part of the reason why there is this persistent, because I agree with you, I think the bubble in the world is in global sovereign debt, and particularly Western sovereign debt. This persistent overvaluation is simply a lack of experience, a lack of imagination. It's part of just the human condition that we, generally speaking, most humans don't react to something until we've experienced it personally. And we saw that in the housing bubble, for example, back in 2004, 2005. People were famously saying, look, it's impossible that we can't have a national housing bubble. Home prices have never fallen in the United States nationally. It was simply a failure of imagination, because the fact is they had fallen nationally. They fell nationally during the Great Depression. It was just everybody who remembered it was dead.
Yeah.
So I think there's an element where everybody who remembers the last global sovereign debt bubble in the West is dead. There's no one here to say, hey, I've seen this before. I remember what to do. You have to have some imagination. You have to have some reading. So I think that's part of it. I also think part of it has been Western authorities have been very effective in regulating treasury bonds in particular, but sovereign debt more broadly, into the system as a safe asset. And so there are people that I'm sure we both talk to that they understand everything we're saying. They understand the debt has to be inflated away. They understand all of that. But the fact is, per regulations, their institution has to have regulatory capital of X. And the only thing that satisfies those regulatory capital regulations are treasury bonds or sovereign debt. And so they have to hold it. There's some duration matching within pensions, and so as long as they don't care what treasury's yielding, as long as they can lever them up and cover their obligations, if you're a public or private pension, then they hold those, and that's their investment goal. And I think from the gold side of things, you have seen this expansion of paper gold derivatives, unallocated gold, particularly centered in London over the last 20 years. That has effectively sated demand that would have otherwise gone to physical gold and perhaps bid the price of gold up. And so they've been it's been a way for them to manage inflation expectations and manage sovereign debt demand, and it's worked. And that's why sort of the fly in the ointment, so to speak, has been crypto, because they haven't been able to create the unallocated derivatives of crypto, and in particular Bitcoin. It's much more decentralized, so it's much harder to push markets around like you can with gold. And that, I think, is part of the reason why we're starting to see all of this antipathy toward Bitcoin and crypto from some policymakers, because I think they know at some level that it's the fly in the ointment. It's the smoke alarm that's warning about what they're doing.
Governments don't like competition when it's time to
they do not
to create money.
Yeah.
You've mentioned a couple of very interesting points. First, debasement of currency, and second, the discrepancy between the physical demand and the physical market in gold relative to the paper market. The debate these days, at least in the mainstream media, etc., is consistently that what we're seeing right now is an increase in inflation because of supply chain disruptions, and that is transitory, as Chairman Powell has said. We never know what transitory means. It can be 3 years. Therefore, you cannot blame the rise in the price on supply constraints when overcapacity has been perpetuated. What we're seeing is what you just said, is currency debasement, and actually currency debasement not just in dollars, but also in the main currencies of the Western economies. Do you think that that is something that people are starting to realize, and that's why so much money is flowing into inflation-linked assets?
I think on some level, yes, I think they are. I think I think there seems to be the reflation trade put on in a big way, right? Where it's just that part of the cycle We had a severe and steep but short recession. You're coming out of it. And there's a very clear playbook for that. It's, real rates start rising off the lows, and you buy commodities, and you buy banks and financials, and the yield curve steepens. And there's sort of been this playbook, and all of those things have made sense. You sell gold, and so we've seen this bounce off the lows in real rates since last August. Gold has fallen. The FANG stocks, the big tech plays that were effectively duration proxies, they've all sold off the highs and have been trading sort of poorly year to date. Meanwhile, we've seen this reflation trade and commodities doing very well. And so I think it's an element of that. I think it's an element of the currency debasement around that. I think there are also I've been told there are elements of the supply disruptions that are for lack of a better word, man-made or artificial.
Yeah.
It's not just about whether it's what we saw last week with the jobs report in the United States, where there's a lot of small businesses saying we can't hire people because they are getting paid too much on unemployment. I have also heard multiple situations where corporations might have 6 production lines. They had to take 4 production lines down during COVID, either because of demand or because they couldn't get the workers because of just the protocols. Um, and on the backside of that, when they could go back to 6 production lines to address the demand that is there on the reopening, they're not doing so. They're voluntarily staying shut because they now have systems that are so good, these corporations, they can say it's better for our return on invested capital to leave 4 of the 6 lines shut and raise prices 50%. And our ROIC will go up. We are acting in the best interest of our shareholders. We'll keep the other 4 lines closed, and you've had this consolidation of capacity in so many industries that I think there's a lot of industries where this game plan's being run is, hey, we'll just jack price. The market's paying it. There's this narrative of inflation, so nobody's questioning it. And I think in the last week or two, you saw that. You had Yellen come out and say, well, there's no inflation. We're not inflating. And Sam Zell, American billionaire, one of the best investors of this, says, oh my gosh, it reminds me of the 70s. There's so much inflation. We're seeing it across our business. And a day later, Warren Buffett, one of the best investors ever, oh my gosh, there's so much inflation. We're raising price everywhere. So, as we wrote to our clients, who are you going to believe, Janet Yellen or your own lying eyes, right? So, I think there are a combination of both man-made factors, currency debasement going on out there. And I think we're watching that happen.
Yeah. Um, going back to the gold physical versus paper that you mentioned before, we've seen a very thin line that has been maintained for a few years in terms of investors are happy to take the risk of big negative nominal and real returns on their sovereign bond holdings because they see, okay, there is allegedly no inflation, or at least no official inflation. Central banks are going to continue to pump liquidity, maintain very low rates. Growth is going to be subdued, but sort of okay. And suddenly there's in that sort of deck of cards, there's something that is broken the narrative that needs central banks to continue to pump massive amounts of liquidity and maintain very low rates, which is obviously inflationary pressures. Do you think that is where, now that we see, for example, gold bouncing back to 1800, etc., that is where we start to see that difference between paper gold and the true demand supply picture of gold starting to be realized in the price?
I think that's one way it could happen. I think ultimately you could start to see premiums like we saw last year for a little bit in March and April of last year, where you saw premiums on physical blow out relative to the paper markets. There were some supply disruptions around COVID, air freight, et cetera. I think you could see something like that a little bit more structurally, particularly if what I think is going to happen is correct, which is the big narrative that I'm not seeing virtually anywhere is that with the United States, the reserve currency issuer at 130% debt to GDP, the whole sort of slow growth isn't an option anymore. They've got to gun this thing. They have to really make up for lost time. They've got to keep growth well in excess of interest rates to try to earn their way out of it. As an example, the last time U.S. debt to GDP was over 100% was in the immediate aftermath of World War II, and we saw the U.S. Take debt to GDP from 110% down to 55% in just 6 years.
Yeah.
And the way they did that was at the lowest, U.S. real rates were at negative 14%. And so there's this narrative that August was the low in real rates, and
Yeah.
that at negative 1.1%, and we've bounced back a bit. Maybe we're rolling over a bit in real rates back towards more negative levels in recent weeks. But to me, I've always thought that that was a false narrative. That negative 1.1% being the bottom. There's no way. Because the debt to GDP is so high, you can't normalize policy until you have that number way lower, without blowing up the U.S. government, without blowing up the economy, because the debt levels are so high. And so you've got to get that down. The only way to get that down is by financially repressing the system significantly. And so, from 1946 to 1980, U.S. real rates, or excuse me, U.S. nominal 10-year rates were consistently 500 to 800 basis points below the rate of nominal GDP in the United States. So you got killed on a real basis holding treasury bonds, and that's how the government got out of it. And so I think as we transition, as I expect that we begin to transition from this view that negative 1.1% was the bottom and real rates, to, oh, wait, this is different this time. It's different this time versus the past 60, 70, 80, 100 years, but it's not different versus any other time where you've had twin deficit nations going over 100% debt to GDP. They always get out of it the same way. They print their way out of it. They repress bondholders severely, and things like gold and hard assets and commodities and real estate all do really well. I think as that narrative shifts to, oh my gosh, then I think there's a chance you start to see the physical market reassert itself over paper markets. I don't know that you get the big dramatic spread blowouts like you had for a few weeks in March or April last year, but I think you start to see the physical market tighten up to the point where basically the paper market has to cede ground to the physical market, and maybe you see the gold start to act better at that point. And I think maybe we've started to see that, quite frankly. I think some of this move we've seen the last $130, $140 higher in the gold price, I think is beginning to reflect that possibility that negative 1.1% in real rates on the 10-year was not the low, that it's going to go lower, that it has to go lower.
That is something that I had an interview recently in which somebody asked me if I thought that the United States would go down the negative interest rate route. No? And I said, well, I do, actually, of course I do. And why? Because there's very little other option, but you can go that way in two ways. One is the Eurozone or the Japanese way, which is to have real, nominal negative yields, or to have inflation rising and real rates significantly below that level of inflation. Both ways are actually negative rates and suppression and repression of financial repression of bondholders. What is the risk, in your opinion, there that the flow of capital into U.S. equities that tends to be significantly higher because of buybacks, because of much higher levels of margins and returns relative to others, changes back to areas where you don't see that level of risk, or where it's already at least embedded in valuations?
I think that's right. I think that's the challenging part of the situation that's been left in the aftermath of COVID for the Fed in particular, which is, because we're the global reserve currency, in my view, it's very difficult for them to take nominal rates negative, because the capital is here, because there are $7 or $8 trillion in dollar-denominated FX reserves globally, far greater than any other region or nation. If you take nominal rates negative, you're going to have $7 or $8 trillion starting to flow out of sovereign wealth funds, FX reserves, into higher yielding assets, gold, equities, real estate. So they could do it, but that for the United States is much more of a political question. It's not one the central bank can make on their own, because again, that cuts right to the heart of, dollar's reserve status. If you ask me, is there a way the U.S. could lose dollar reserve status? To me, yeah, it would be you take nominal rates negative enough, and that could start to do that actually. But I think, to your point, the challenge for the Fed is all that capital is here.
Yeah,
U.S. net international investment position, which was, as you know, it's just a measure of how many assets foreigners own of Americans versus we own of foreigners. And in 1998, the net international investment position of the United States was negative 3 or 4% of GDP. In 2008, it was negative 7 or 8% of GDP. It's now negative 60 to 65% of GDP. Foreigners have just brought in so much capital over the last 15 years that it does trap the Fed a little bit into a scenario where they need to get inflation up, but not up so high so as to scare the dollar down and scare the capital out on fears of dollar depreciation, because that's their worst nightmare, which is dollar down, capital flight out, because now they're going to have to tighten to keep the capital here in the midst of a slowdown. That's a big problem. Prior to COVID, that was a viable game plan,
yeah,
because the debt to GDP was still, it was getting worse, but it was at least within reach. After COVID, 130% debt to GDP, debt growing at 9% per year CAGR for the last 12 years. That's not really a playbook anymore. They have these two competing interests where they need to have significant inflation to drive significantly negative real rates for probably 2 or 3 or 5 or 6 years on one hand. And on the other hand, they also need to not have that, what is implied, a significant depreciation of the dollar, basically these significantly negative real rates, drive a significant outflow of all of this capital that has flocked here. And so they have sort of these two competing masters they need to serve, and they're trying to serve them both. I've equated to they're trying to ride two horses with one ass, and the horses are starting to ride in different directions, and they need to choose. And I think they've chosen. I think they've chosen the only choice they have is really inflate,
yeah.
because the other way ultimately starts to put the U.S. Treasury market at risk of having a failed auction or of defaulting. That's simply not going to be allowed to happen. So I think they've chosen. I think they're still having buyer's remorse. And so I think the game plan right now is we're going to inflate, but we're going to jawbone a lot. We're going to say crypto's bad, or we're going to say we're going to crack down on crypto, and we're going to say inflation's not as bad as you think. And all these things that when we're going to taper maybe in 6 months, or maybe, you get this steady flow of Fed officials talking about, well, we need to start thinking about tapering, or all of these, just to try to keep people honest, try to keep the bond market honest. But I think we're starting to move to this point in markets where they're starting to figure out they've made their choice. They had to make their choice. And it's inflation. I think we saw tremors of that in February and March when we saw the bond market back up the way it did here in the United States, and the Fed's balance sheet grow a little faster than they targeted for a couple of months. But that's ultimately the challenge when you say, hey, what's the risk? The risk is now, at any point in time, if they don't do enough, you're going to have nasty risk off around the world, sharply higher dollar, sharply higher volatility, and the market's going to beat the heck out of the Fed until the Fed gets religion and says, "Oh, sorry guys, we didn't mean it. We're going to go back to inflating now," and just a faster, more violent version of this playbook we've really seen over the last 5 or 6 years.
Where do you see that can crack? Because obviously, we heard we've heard it a few times, but obviously the market moves much faster. What is the risk that such a delicate balance of message plus real assets, currency, and financial assets starts to crumble, or at least be at risk of crumbling severely?
I think it'll have to be some sort of, it's really, I think to me it'll be either a real world event or just sort of a
Yeah.
confidence thing. And so I think either one of those things will center around sometime in the next 3 to 6 months, where it becomes apparent that the transitory factors that are driving the transitory increase in inflation are not going to be transitory. In other words, we did it, we were supposedly recovering, and Biden comes in and does $1.9 trillion stimulus in spite of what the narrative was of, hey, we're recovering, let's do another $1.9 trillion. And then a month later, let's do another 2.2. And there's another 2 trillion on the come. Okay, fine. And so there you saw the bond market sort of wobble to that. I think a potential event is we get into the back half of this year and the economy starts to slow a little bit, and then we have to do another 3 trillion. And then and maybe that starts another wobble of the perception of reality versus this narrative. They can sort of ride both horses. That will start to be, oh my gosh, there's the inflation horse is starting to sprint away. I better get on it. And maybe it's that 3 trillion, or maybe there's another 3 trillion after that. But at some point on this path, again, because the GDP levels are so high, the deficit to GDP are so high, the deficit to tax receipts are so high, so much of the deficits are on interest expense, entitlements, and defense. They don't really have a choice of cutting anything. U.S. government is 25, 26% of GDP. So you really can't cut a lot without sending the economy into a recession. If you send the economy into a recession with debt to GDP to 130%, you go into a debt crisis where yields start rising and stocks start falling, and you're sort of right back to the worst days of March 2020. So to me, I think there is still obviously we're seeing it in market prices, a credulity, a belief amongst market participants that it is still transitory, that the stimulus, that we are just going to go right back, we're going to reopen, and then there's still a possibility, but at some point a moment is coming where a quorum of market participants are going to realize it's not possible. It's mathematically impossible. We're not going to get away from this. The only way out is 3 trillion a quarter in stimulus for the next 5 years. And that moment, once that hits, it'll be like a shot. And that will be really interesting because the Fed's balance sheet at that point, it'll stop growing linearly and it'll start growing non-linearly because the bond market will start selling itself to the Fed effectively.
An interesting viewpoint as well is that when the government finds itself in such a challenging situation, mandatory spending is going through the roof. They can't even cut that. They can't even touch it. It doesn't matter if it's a Republican or a Democrat president. On the other hand, the effects of each of the stimulus packages lasts a little bit less every time. We just saw it in the jobs report in April, no? And consumption figures as well. You see that it doesn't even last for a quarter. You put a couple of $1 trillion into the economy, and it doesn't last for 2 quarters, no? It looks very much like what we have lived in the European Union, in the Eurozone, since 2001. And what that leads, and that probably is what very few people are expecting, is either stagflation or a much weaker level of job creation than what the consensus has in their numbers. No, what is your view there?
Yeah, I think it increasingly points to, especially when you're talking about the shrinking of productivity of stimulus. So every time we do more, we get a little bit less out of it. I think, and the high levels of debt we're now at, it speaks to the policymakers no longer having a dial. They always like to refer to themselves as having a dial. We can dial up a little bit more. It's not a dial anymore. It's a switch, and it is inflation, collapse, inflation, collapse, and that's their choice. And I do think in a lot of ways it is similar to the problem you've seen in the EU for a long time and in Japan for a long time, but I think it is an important difference, which is the EU is still internally funded. You guys, is in aggregate, for all of your disagreements, you are running basically a flat fiscal, slight fiscal deficit and a trade surplus. And so on a current account basis, you're roughly flat, and you've been roughly flat for this entire time.
Yeah.
The Japanese have our current account surplus nation, big one. And the Japanese and the Germans in particular have massively positive net international investment positions. So when you think about, for example, the Japanese are a perfect example, which is if the Japanese want so far they've been internally funded, right? So
Yeah.
their own pensioners fund their own fiscal spending, and deflation works for them because the living standards of the populace still rise because yes, they're getting low yields, but their costs are falling, so the real yields are actually still positive to their investors, who are their own people. If the population in Japan gets so far, or they get so satiated with Japanese debt that they stop buying, the Japanese still have two more options. Number one, their national income comes in every year. They're running a current account surplus. Every year they are selling more than they buy. So they're getting some borrowing room more every year from that. But then they have this massively positive net international investment position where in extremis, they could still call up primarily the United States and say, we want all our money back. Give us our money. And they could use that to finance their own. Basically, they would be eating their seed corn at that point. But they could eat their seed corn for a while. Europe is in much the same way. Now it's very bifurcated. The Germans are very much in the same boat as the Japanese, and the Italians and the Greeks, and some of the southern regions are very much more actually look like the United States in terms of their current account position. But if you look at the US's current account position, we're the biggest current account deficit region in the world. That's been offset by our capital account surplus, where we export treasury bonds to the world. But as we were talking about earlier, foreign central banks aren't buying these treasury bonds anymore. So our biggest export to balance our current account deficit, we're not exporting it anymore. We have to buy more of it ourselves. And so we then get to that question much quicker, as with the Japanese, is we were externally funded. It's less so now. We're trying to internally fund now, but we don't have national income coming in. We have national income going out every year. And we've already more than eaten all of our seed corn. Our net international investment position of negative 65% means we have been dining on our seed corn for 20 years. We've been having fantastic feasts with it. It's been wonderful, but now we have no seed corn to eat. We have no income coming in because we're deficit. And the world, by and large, doesn't want our biggest export treasury bonds anymore. And so when you think about the problem, you go, okay, there's two outcomes. Okay, we slash spending, which is massive depression, but politically impossible. Or the Fed finances it all every year, more. And I think that's when I have conversations around dollar versus euro in particular, dollar versus yen or dollar versus yuan. That's why I see the dollar as just being structurally weak. At any point in time, it could rally. We can always not do enough and go into depression, and the dollar will rally like crazy. But I think structurally, once you consider the political unlikelihood that we're going to cut anything, then you're in a situation where the Fed's balance sheet is going to look like the Japanese balance sheet. It's going to look like the biggest balance sheets in Europe over coming years, because the only person left to finance these marginal expenditures is the Fed with printed dollars.
However, there is a general consensus, I would say, out there that the United States will not follow the siren calls of MMT, of modern monetary theory, which is not modern or a theory, which has been implemented,
No, it's not.
has been implemented for centuries everywhere. People, don't forget this. And you see that the so-called economists that support this theory are surrounding the White House. What do you think? What do you think of the risks of that actually happening? Really, not just what we're seeing right now, which is some sort of digression of quantitative easing, but not MMT in its full glory.
That's what I was going to say, is glory. Yeah, I agree that what we've been seeing is MMT light.
Yeah.
And it's very interesting because when you listen to the MMT, the sort of the most rigorous proponents of MMT, what they will tell you is the only spur, or the only break on it, right? The only impediment to it is inflation.
Yeah.
Right? Is that once inflation gets too high, then you have to stop it. And what's really interesting is we just did a little bit of it. We nibbled. What we're doing with Biden is MMT light. The problem when you try MMT, when you are running an $800 billion a year trade deficit, is the inflation shows up now. in a big way. We're importing everything. And when you try to do it now, to your earlier question and point, the $64,000 question on that front is how much of that inflation showing up now is transitory supply chain problems that will resolve in time, and how much of it is simply you're an $840 billion a year trade deficit. If you run MMT in its pure form, you are going to jack inflation way higher immediately. And that, to me, I think is still undecided. And I think that filters back to the question of when does the bond market or when do markets really start to get freaked out? When do they lose confidence? Do I think the US will do full MMT? I do. I don't think there's any other way out. To me, the only question is does there have to be another austerity scare or deflationary scare where we try to back away and let the economy grow organically? But I think, unfortunately, we've let things go for so long, and we've made some really bad decisions in terms of investments with our foreign policy over the last 20 years, whether it's offshoring so much to China or going to war in the Middle East for 20 years to effectively secure China's oil supply chains, which still makes no sense to me. But we're so far gone in some of these decisions that we can't reverse. I think some full-on version of MMT is an inevitability at this point for a period of time. And it could actually be really positive if we spend the money well, right? When we did the Eisenhower highway system here in the United States in the 50s, the productivity benefit was extraordinary. And there are arguments to be made that if it's spent well, they could be extraordinary again because we've underinvested in infrastructure for so long, in part because of some of the things we've done over the last 20 years. Now, again, the $64,000 question is how much do you trust the politicians in Washington to make extraordinarily wise decisions and make investments in infrastructure where there will be a significant productivity payback over 5 years, 10 years, 15 years. The opportunities are there. Are we wise enough? Do we have the right wise leaders to do that? Or are we just going to get into a pattern of here's $3 trillion, go buy Dogecoin, and we'll come back in 3 months and give you another $3 trillion to buy more Dogecoin? Then that begins to go into a very scary situation where you start putting Argentina, Venezuela type end games on the model for the on the table for the United States, as opposed to, hey, we're going to spend $5 trillion on light rail infrastructure, high-speed rail infrastructure, port infrastructure, and you get these good paying jobs, demand, et cetera. That's a different game. So I think it does depend, but I don't think we're going to get out of a period of the full-on MMT just based on what's happened historically.
And the concept of spending well, unfortunately, that ship has sailed a long time ago, and we're seeing it as well with this next generation EU. Next generation EU sounds like a Star Trek episode, but it's little more than that. Science fiction. One thing that I'm certainly sure of is that if the United States tells the European Union that they're going to lose their intellectual capital, they probably will say, "What intellectual capital?" No? Just ending with a joke. No, the European Union has a lot of great things, and we need to value them. Luke, it's been a lot of fun. We've had I think it's always interesting to see different angles, and your perspective on things is super interesting. Everybody that's watching us, follow Luke. You have all his details in the description of the video below, and look forward to continue with this in a few months' time, because I'm sure that there'll be a lot of things to discuss. Thank you so much for your time. It's been a great conversation.
Thanks for having me on, Daniel. It was great catching up. I enjoyed it.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.